So guys, this is Theta Gang, and I have decided to start running the wheel. It's finally time, I'm ready to do it, and what I did was sell a put on NAT. So for those of you unfamiliar with the wheel, selling a put is the way that begins. I'll discuss the wheel near the end of this video. This is basically amounting to buying NAT at a cost basis of $520 in the event of assignment. And assignment here is the worst case scenario. So a quick rundown for people who aren't familiar with puts. The way this works is a $6 put means that I've agreed to buy NAT for $6, and whoever I sold this to has the right to either make me do that or not. And so the only reason they would do that is if NAT has fallen anywhere below $6 before the expiration, because this contract expires on May 15th. After that, it disappears, and what they've paid me has gone fully into my pocket. And since they paid me 80 cents a share, that's where I get my cost basis of $5.20. For them to profit, NAT would have to fall below $5.20. So if we look at the options chain, there was a lot of things I could have done. And if we actually look at puts, we can see this is the $6 put. For me, it's good when this price goes down because right now, this price is really a debit against my account. Because to close this, I would need to buy one. You can see it says -1 contracts here. So if I were to buy this contract back, I could pay $75 because each of these contracts represents 100 shares. And overall, I would net $5. Now, I don't want to do that just yet, but I could see that happening later on. And if you were to do this yourselves, you could easily, even safer is the $5 put. You can get 50 cents a piece on these, because these trade in 5-cent increments. The 48 cents is just the midpoint between the bid and the ask. There you would be guaranteeing yourself a cost basis of $5 a share in the event you get assigned. Now, the reason I chose Nordic American Tankers for this was because if you look at their graph, they've been doing great, and I think everyone knows why. It's because they're storing so much oil as a result of this huge surplus we have. So you can see, February, they were doing okay, just going along. They got one big spike earlier last month now, then kind of retraced a little, and then just spiked huge again the other day, and actually reached as high as $9. This doesn't show you just how high they got, and now they've kind of come back down a little bit. But regardless, none of this really scares me that much. Because if you've watched the CEO, and this is his name, I can't pronounce it, but his interview with Jim Cramer the other day, he talked about how much they were charging. And right now, they're charging $70,000 a day to store oil, and that comes in 6-month time increments. So they're going to be doing quite well for 2 quarters. Over last year, for almost the entire year, they were charging $15,000 to $20,000 to store oil. The CEO also mentioned it costs them $8,000 a day to do this. So if we just run quick numbers here, assuming costs were the same, which might not be the case, seeing as one of their biggest costs is gasoline itself or just fuel for their ships, costs may have gone down, but either way, let's assume it was equal. They were making about $12,000 all last year, and now that number has jumped to $62,000, and that's per day. So obviously, they're going to jump a lot. Their revenue alone is up 517%, so they're in a really good situation. The beauty of the May 15 contracts is that they expire right before the ex-div date. They also expire before earnings. This is the Q1 earnings, which won't be as exciting, although they did start charging $70K a day. So these earnings could be set to be pretty good, but really it's Q2 earnings that are going to be unbelievable. This ex-div means if I get assigned on or before May 15th, I'm going to be holding shares. And what ex-div means is that as long as I hold the shares before that date, on or before, I'm entitled to the dividend. And they've announced the dividend coming up is going to be 14 cents a share. So if I get assigned on this contract, I'm going to get $14 right in my pocket as long as I hold through the dividend. And that is fantastic for me because it could also act to lower my cost basis, if nothing else. The CEO also mentioned they're going to be completely debt-free after this event, and he's going to be paying massive dividends. So holding shares could be a very good thing. Now, this isn't something to hold forever. I mean, eventually they're going to come back down to earth, but it does not look like this oil thing is going to be sorted out quickly. So it does look like there is a lot of opportunity here. The one downside with this current strategy is that it caps my gains to the $80 I collected. So if I wanted to, I could have just gone ahead and bought 100 shares because they're holding $600 collateral anyway, so that I have enough to buy the shares regardless. I could have just gone ahead and for 25 cents more bought the shares myself, but I've been looking to start running the wheel, and I thought this was a very good opportunity to begin that. So let me describe the wheel for you guys. So this is the wheel, guys, and this is my attempt at drawing you a wheel. And I'm going to describe it here. If you want to learn more or see another video on it, right now I'm going to throw up a card linking a video that I really liked that really taught me the wheel well. And since this is going to be a pretty quick overview, if you don't catch it right away, I would go ahead and watch this video afterwards. And if you hate me in general, don't worry, it's not my video, it's someone else's, so you don't have to worry there. But the way the wheel starts is you're sitting on a big pile of cash, and this is when you sell a cash-covered put, which is what I just did for NAT. And what happens when you do that? Your cash goes over to the sidelines, it gets held, and you receive cash from whoever it is who bought the put. And assuming the stock stays up, so in my case, if NAT stays above $6, I keep what was just paid to me and my original money. So I've increased my cash pile, and I can keep doing this over and over and over forever and just keep accumulating cash. Now, if we go back here, in the event that doesn't work out, I will end up holding stock. So my cash goes away, I buy shares of the stock, and that's when you move on to step 2 in the wheel. And step 2 is to sell a covered call. So for those of you unfamiliar with calls, they're basically the opposite of puts. Instead of me being forced to buy shares, I'm instead forced to sell, and the collateral becomes the stock. So in this case, stocks go over to the sidelines as collateral. I just gained a little bit more money, and I go ahead and see what happens. So as long as the stock stays below the strike price, they'll have no reason to execute, and I'll keep the stock and the cash. But if we go back here, that might not always happen. Sometimes the stock will exceed the strike price, in which case the stock gets called away, you receive cash for the stock, and you can start running the wheel once again. That forms one revolution of the wheel. And so as long as you're picking good strike prices, this can be a very good strategy to run, and that's what I'm starting with NAT here. So as you can see, this is the same diagram, just showing my actual position right now. So I've collected 80 cents for the $6 put. And if we jump here, this vertical line represents the price that the NAT shares could be going for. So at $6, that's the strike. That's really when the put can start to matter. And at $5.20, that's the break even. And you can kind of see what goes on there. So above $6, I will reach a max gain of $80. So over the basically 2.5 weeks, I would hold this contract. If NAT finishes anywhere above $6, I'll make 13% back on the collateral that was being held back, or 9% overall in my portfolio, which is pretty good. Now, anywhere below $6 going to $5.20. Now, anywhere below $6 going to $5.20 would represent kind of, not loss, but not max profit. So if NAT is $5.21 on May 15th, or whenever I get exercised on, I'll gain $1. If it's $5.99, I'll gain 79, and every penny in between is another $1. It's only below $5.20 where I could end up losing a lot. And as I've shown here, my max loss is $520. So if NAT goes bankrupt, their shares are worth $0, I lose $520. Now I think that is extremely unlikely to happen, so I'm thinking this is pretty safe. Now the other thing I'm not showing here is, of course, I could have just purchased shares outright. So if NAT goes to $100 a share, I obviously missed out big because I won't gain nearly that much. but this was the position I was comfortable opening up with, and it should be a decent play. And this is really how the wheel works, guys. It's fairly straightforward. So in the event I do end up below $5.20 or even below $6, I can run to the covered call portion of the wheel. Now between $6 and $5.20, I can really make a decision. I'll have the shares, but I could sell them for a profit. So even though I bought them for $6, I've still got the cash that was given to me for them. So I could just sell and, realize the profit, or I could start running covered calls. But hopefully this was a good brief description on how the wheel works and what my position in NAT is. And I hope it helped you out. And more importantly, I hope it'll help you make some money. And if it does, you might want to make sure you've subscribed so you see some more of these types of videos. But guys, I don't want to take up any more of your time. So that's it for this video. I'll see you next time.